The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Main Street's pain is Wall Street's gain. Live from Studio 2 here at Bloomberg headquarters in New York. I'm Romain Bostic, kicking you off to the close here on this Wednesday afternoon, the second day of gains for the broader markets, with the S&P 500 fractionally higher, up about 0.5%. You're seeing a big bid come in right now to the bank index. The KBW bank index up more than 2%. A lot of that tied now to speculation about what the Fed may do next. The idea that that shift in rates could end up being a net positive for that sector. A record day for copper. But when you take a look at the big sectors out there moving on the day, you take a look at big tech, and it has been a laggard. In fact, it's been a laggard right now for the past 5 weeks. In fact, when you take a look at the catalyst for today's move higher, it is clearly tied to bets that the Fed will move interest rates lower. Economic data supporting that thesis, including private payrolls numbers out of ADP this morning, showing U.S. companies last month shedding jobs by the most since early 2023. Chris Zaccarelli over at Northlight saying that while there will be dissents at next week's Fed meeting, in his view, it's a sure thing we're going to get 25 basis point cut with that announcement. The big question, though, is will it actually matter? Quantitative analysts over at Barclays suggesting that while a more dovish Fed contributed to the recent rally at the margins, it may not have actually been the primary driver. In fact, since the start of 2023, the influence of monetary policy on stock prices, that's actually faded. Realized moves post-FOMC, that's actually been hovering near zero as of late. So if the Fed can't move markets, that puts a lot more pressure on the AI trade. And, well, let's take a look at how that's going. Technology stocks as a group, the main laggard today, as they have been for the past 5 weeks. That report from the information this morning that Microsoft salespeople have missed AI sales targets, adding a lot to that scrutiny. Some comments out of Anthropic, as well as some news on Morgan Stanley adding to that concern. And we're going to get some more insight out of earnings tonight from Salesforce, which just 3 months ago rattled the market when it, too, suggested AI adoption was moving a touch slower than planned. So as the market, of course, tries to get a feel here as to where the AI trade goes next, a lot of people, of course, are looking to some of those reports about the hyperscalers and exactly what's been spending. Let's kick you off to the close here, right now, with Alex Haissl, analyst over at Rothschild Redburn, to talk a little bit more about that report that we got this morning. And Alex, I do want to start off with this report from the information and make clear that Microsoft has already pushed back on it. But the gist of it was something that we've actually heard before, including out of Salesforce just 3 months ago. This idea that the adoption of some of these AI products moving maybe a bit slower than some folks had anticipated.
Hi, good afternoon. Really appreciate you having me on the call. I think even if the company has denied the report, the debate doesn't really go away, because if you just follow the data, what you can see is that, compute consumption and also revenue contribution from generative AI is really coming from training these models and consumer-facing inferencing. So if you really were to break it down in terms of like application, it's a small proportion, and within that, it's driven by soft development, which is, these are the tools that are consumed by the product tech ecosystem. So I don't think the debate will go away. In fact, I think it will just intensify, because investors do question what the return on all of this capex really is.
I am curious with regards to those capital commitments. I mean, we kind of talk about it as a lot of this money has been spent. A lot of these right now are still commitments, still the idea that, in theory, if some of these companies wanted to pull back from some of those commitments, I would assume they have the ability to do so, right?
Yeah, I mean, that there will be adjustments, but looking into next year, we're pretty certain, that the capex will be spent and the capacity will be online. So I think there is an increasing risk of, building too much and the risk of overcapacity. And this, what we have said in the past, is the fundamental difference between generative AI and the cloud 1.0 is the cloud really just started to scale on a very, very efficient stack. What is happening in generative AI is massive scale and an inefficient stack, and this really increases the risk of overcapacity. So even if they could pull back, I think there's a significant risk.
Alex, I just want to read something to you. A little bit earlier today, Dario Amodei, of course, the head of Anthropic, was at an event with the New York Times, and he was asked about the AI spend, and he was very blunt, talking about there's a real dilemma out there right now in terms of balancing that spend with the potential return. And in his words, basically said that right now he thinks a lot of companies have actually taken on too much risk with regards to some of these commitments.
I mean, that's correct. I would agree. I mean, we think that, just renting out GPUs or GPU deployments over 15-year lifetime only generate around 20 cents per dollar spent. And that assumes, that this capacity is fully utilized. So the risk of the number is obviously skewed to the downside. And that's a really big difference compared to the Cloud 1.0, where for every dollar spent, you get $1.40 back. So there is risk. And I think investors are really questioning this. And there are quite a lot of nervousness out there.
I mean, one of the arguments that I've heard, at least when it comes to the hyperscalers and the data center builders or operators, if you will, was this idea that if that capacity isn't necessarily assumed by AI-specific uses, that there are still other uses for that compute capacity, whether it's just traditional cloud business. Is that a realistic option if for some reason the AI spend doesn't actually follow through?
I mean, the challenge that you have is if you take a Microsoft or Amazon, maybe 25 to 30% of the spending is like traditional cloud, so CPU-based servers and storage. But the bulk of the incremental spend is coming for generative AI, being it like GPUs, so in AWS's case, we think 50% for Trainium 2. So you would need generative AI workloads to really fill this capacity.
So what happens then, Alex, if that capacity isn't filled? What should investors anticipate if that day comes?
You will have underutilized assets, right? So you have two options. Either you build these data centers and then you have underused capacity, or if you're like an Oracle and you sign a 15-year lease with a lot of capacity, you have fixed costs. I think that's the problem that we really see is investors taking a big bet already that enterprise adoption is taking off, but no one is seeing the other side that, for a lot of these projects, this could be really value destructive.
Alex, really appreciate it. As always, some of the research you're doing out there has been absolutely phenomenal here. A much more sanguine look here at the AI spend. Alex Haissl, analyst over at Rothschild and company Redburn. Of course, we started the day with that news out of the information that rattled markets. The Anthropic CEO speaking in a report by Bloomberg just a little while ago that Morgan Stanley is actually considering as some sort of a strategic risk transfer when it comes to some of its data center investments, or I should say funding that it has lent out to some of those other companies. We want to keep this conversation going, not just about what's going on in AI, but the broader markets as well. We're going to go from one Alex to, Alexandra. Alexandra Wilson-Elizondo joins us right now, the global co-head and co-CIO of multi-asset solutions at Goldman Sachs Asset Management. Great to have you.
Thank you so much for having me.
Before this morning, when I knew you were going to try to hold another list of questions that I was going to ask you, we'll get to those in a second. Okay. But I do want to start with the AI trade. I mean, that has been the real fuel for this rally that we've seen over the last 2 or 3 years or so. And I don't think anyone's saying that trade is over. But you see a lot more scrutiny right now of the AI spend and what that return is. Are you doing that same type of scrutiny?
Yeah, anytime you add leverage to a theme, it gets more complicated. And I think what your prior guest was alluding to is that, right now some people are outspending what they can afford. Mm-hmm. And the market's pretty discerning about that. Mm-hmm. Ultimately, though, what we're focused on is, what is the use case for AI? And if we're going to completely replace something like yourself and myself, we're in the very beginning innings, or are we just going to be leveraging it for productivity? And I think that question remains. That's why so many people are bringing up the topic of bubbles. It's just there's risks in the system, and we need to be thoughtful around it. But how we're positioning in our portfolios is, there's a lot of exuberance. We're participating in it, but in a very rational way. We're focused on quality, companies that have ROE, low leverage, the management teams, that they can operate throughout cycles. And honestly, that trade's been really cheap relative to what the broader market has done.
What types of companies are these? Are these companies selling AI-related services? Are they companies using AI internally to boost their own productivity and increase their own value? What types of companies?
Well, more holistically, quality is actually across the sectors. So it's very much so focused on high ROE, low leverage names. Some of them are participants in the AI theme. Two of them are very large, tech issuers. But it's more holistically focused on, hey, a lot of things are really expensive right now versus history, if you will. And we see that this space has a lot of value. And it's not just domestic, it's also international. So the quality basket is, trading 17% cheaper than the broader index internationally. And you're getting exposure to places like India and Hong Kong and more diversification for the portfolio.
Has that been a tough sell, though, for particularly like when you're talking to clients and other investors and even your peers? Because so much when we hear about the AI trade, it still seems narrow, or at least the discussion publicly seems narrow, both in terms of the industries, but also geographically, too. A lot of focus here on the U.S.
Yeah, that's true and fair. Although you look at Europe, and Europe in dollar terms is completely outperformed and has very narrow exposure to AI. So I think thematically people question it, but when you talk about risks that you're exposing yourself to, what happens when you have a concentrated index, how the beta of your portfolio can go up, I think that it really resonates with our clients. We talk about being invested, being overweight equities, but being really rational in how we're exposing ourselves, and that there is really great diversification opportunities across the globe. I spoke a little bit about how we're getting exposure to quality in India, but more holistically, we're very focused on EM. You have lower inflation, a Q3 GDP print of 8%, and a market that actually didn't get a lot of attention this year in terms of buying.
Well, it's interesting you brought that up, because I did sort of give it some attention last week for like the first time all year, and I was surprised at how much it had outperformed a lot of the benchmarks here in the U.S. So far. Is that something that's sustainable, though? Because I feel like we've gone through these periods where we'll see, at least on an aggregate basis, and I'm just kind of taking like the MSCI index, and I know it's very broad, but we've seen that outperformance before, and then that sort of falls off pretty quickly when people find some other shiny object. Yeah,
specifically when you talk about EM, you can't divorce that from China, and because it's a very large exposure in the index. We're on our third 5-year plan from China. It was very pragmatic policy that we saw, export-driven growth targets that they have. It's easy to see because it's very underowned, and it's trading 1 to 2 standard deviations cheap, even for relative cheapness on history. So we can see more room for that to outperform, but obviously there's a lot of trade tension involved in the space. So you have to be thoughtful in how you size in your portfolios.
So I was looking at some of the things that you've wrote, and it was this idea that one of your contrarian bets for next year is actually to be short investment grade corporate debt.
Yep.
Why?
Well, if you think of one of the spaces that's going to experience the most issuance as a result of the AI trade, it's going to be IG credit. And we've actually seen a couple of very large drive-bys turn to the market recently. Spreads are tight. If you think about one of the largest tailwinds to the index, which has returned something like 7.5% this year, it was duration. And our top line view on where the macro is going next year is that we're going, to have above trend growth around 2.4%. That growth is going to come with higher rates. So we just don't think a lot of the tailwinds are there. Spreads are tight, and then you're going to be the recipient of a lot of issuance as it relates to AI CapEx. And so we're a little bit more discerning there. We'd rather use the capital in equities.
In equities, really?
Yes.
Okay.
Yeah.
Well, what about, too, we had one of your colleagues on earlier, or maybe it was last week, with regards to the launch of Innovator ETFs here. How are you structuring products right now for this outlook that you have for 2026?
Yeah, so, well, first off, we're really excited to welcome them to the Goldman Sachs family. And in particular, within my business, I manage the model portfolios, which give advisors access to our holistic investment content and thinking. And one of the important tools to the toolkit is outcome-oriented solutions. And so you can use things like the Innovator ETFs in our model portfolio business, to protect on the downside, to have more income in the portfolio. And so it just, from our perspective, it's a tremendous thing to be able to offer to our clients.
Yeah, and I should point out we had your colleague on Monday. These days sort of get so jumbled, but I knew it was a recent.
It's okay, don't worry, I'll tell Brian.
Thank you. I love him. Anyway, and just before I let you go, I'd be remiss in not asking you about what's going on with the Fed and rates. I know next week, pretty much a lock, at least the market thinks it's a lock, we're going to get 25 basis point cut. But what's the trajectory beyond that? Are you in this camp that we are in a prolonged rate cutting cycle?
No, in fact, we only see maybe 2 at best, and in fact might be dispersed throughout the year next year, depending on what the information looks like. We're in a higher inflation regime. We expect the terminal rate to be around 3.5. That doesn't give you a lot of room. And if you're operating from the Fed's perspective, they have a lot more tools in their toolkit to address slower growth, less so to address sticky inflation. And so they obviously have been, in terms of communication, a bit more discerning in terms of how much more dovish they're going to be from here.
Alexandra, great stuff. Really great insights. Alexandra Wilson-Elizondo, partner, co-head and co-CIO of Multi-Asset Solutions at Goldman Sachs Asset Management, kicking us off to the close here on this Wednesday afternoon. When we come back, we're going to check in on Macy's. The shares had plunged earlier in the session, now in the green here. Some investors starting to like what they heard out of those results. A conversation with David Swartz over at MorningStar Research, plus a conversation on affordability and the cost of living and how it's affecting political discourse in the midterm elections next year. Rohit Chopra, the former director of the CFPB, going to be joining us as well. Stick around. This is The Close on Bloomberg. All right, time now for our top calls, the big movers on the back of analysts' recommendations. And we're going to start off today in the consumer space, a closer look at American Eagle Outfitters. JP Morgan, which actually cut the stock to underweight 4 months ago, today upgrading the retailer to neutral and bumping the price target to $20 from $14. The analyst over there, Matt Boss, citing momentum with American Eagle's loungewear brand Aerie, which the company expects to achieve high teens same-store sales in the quarter ahead. Those shares on a high, hitting their highest level since May of last year. Next up, Wayfair. Jefferies, which upgraded the stock to buy in March, reversing course today with a downgrade to hold, flagging a clear deceleration in November visits to the home furnishing retailer's website. A sign of holiday season weakness? Well, that's what the analyst says, who also dropped his price target to $94 from $123. Those shares now down about 14% over the past 4 sessions. And finally, let's take a look at Darden Restaurant. Citi trimming its price target to $232 from $239, but it does maintain its buy rating ahead of the Olive Garden parent company's earnings report later this month. Citi expecting a, quote, relief rally before the end of the year, noting that Darden has actually managed to navigate a tough restaurant backdrop. Those shares up for a second straight day, and those are some of our top calls. Meanwhile, when we come back, we do want to talk about Macy's. They came out with the earnings, a beat and raise quarter, but there was some disappointment when we started the session with the shares plunging. They were down more than 6% on the day, but now basically at the waterline. We're going to get some insights out of David Swartz over at Morningstar when we come back after the break. This is Bloomberg. All right, let's talk about Macy's. The shares opened lower by about 6% today, despite a beat and raise earnings report this morning. The main concern for investors, an underwhelming fourth quarter forecast, and concerns about the holiday shopping season. Macy's CEO Tony Spring, he told me in an interview earlier this morning that he sees the guidance for the fourth quarter, in his words, as prudent, and that he's seeing actually some pretty decent traffic so far this holiday shopping season. Joining us right now is David Swartz. He's a senior equity analyst over at Morningstar. Talk a little bit about this report. I mean, you know, the highlight here, David, obviously, you got 3 straight quarters here where you saw pretty sizable improvements in same-store sales growth, some pretty decent guidance that's come up materially over the course of the year. I'm curious as to what more that you want to hear out of Tony Spring and his team over the next few quarters that would give you a little bit more confidence that what's happened over the last 3 quarters is sustainable.
I think that we definitely have seen improvement in Macy's results throughout the year. This is really close to the end of the second year of Macy's turnaround plan, which is really scheduled for 3 years. So next year is really supposed to be the year when we start to see all of the initiatives that Macy's has implemented have a big impact on their results under the plan, which is called the Bold New Chapter. And that includes things like improvement in service in the stores, remodeled stores, remodeled website and digital offerings, as well as more efficient logistics in terms of inventory management. And so those things have been ongoing for the last couple of years since Tony Spring came in as CEO. We do need to see better profitability. Macy's still has low operating margins realistically, and even though its same-store sales are trending upwards, having been positive in this quarter after some years of mostly negative numbers, but the comparisons are also pretty easy. So we still don't really see super strong results here, and so that's, you know, we need to see more improvement to really give people confidence that Macy's is in a different place than it's been in the last few years when it has really struggled.
I am curious, one component of this whole bold new chapter, as Tony Spring labels it, is also, of course, shrinking the footprint overall of Macy's, going from almost 500 stores a couple of years ago down to 350 at some point, revamping all those stores as well. Part of this was supposed to be real estate sales, the idea that they can get rid of some properties that they didn't need it, that would give them a little bit extra cash. That was almost immaterial in the most recent quarter. And I've asked him this in the past. He thinks that that's going to pick up maybe next year. But do you anticipate that they will see any sort of meaningful additional revenue from real estate sales anytime soon?
I don't think it's going to be anything significant. Macy's has really just been selling properties one at a time for the last several years. And this year, the asset sales number that we were given this morning is actually well below the initial expectations. So real estate sales have actually slowed down. And that's not a huge surprise because Macy's is really not that committed to selling the real estate, to be honest. It sells the real estate when it has good offers and when it seems to be prudent, but it's not really part of the overall strategy. Macy's has so far resisted any move to package its real estate and form a REIT, for example, or to sell it off to a financial buyer as a whole, and instead it's selling the properties one by one, and there really just isn't that much demand for 180,000-foot stores, which is what Macy's has. There's very little actual interest in these stores, and so it's not so easy to find buyers for them.
I do want to talk a little bit about Bloomingdale's, David. That once again was a bright spot, 9% comp sales growth year over year. That's almost triple what you had for the Macy's brand itself, and something like 8 times more than Blue Mercury here. Is that kind of, to a certain extent, the future of Macy's Inc. is Bloomingdale's?
I wouldn't say that because it's still relatively small. We don't actually know Bloomingdale's sales because Macy's doesn't disclose them, but I believe that it's still less than 20% of Macy's total revenue. So it's really still a smaller part of the business, but it definitely has been growing faster. I suppose to some degree that's not a surprise because Tony Spring ran Bloomingdale's before he got the top spot at Macy's, so he certainly knows the business well. I also think Bloomingdale's is benefiting from the problems at Saks Fifth Avenue and Neiman Marcus, which combined, and it seems that the combination is not working very well because I keep reading a lot of negative media reports, and Neiman Marcus was in bad shape before the merger with Saks. So yeah. I think there's a potential to gain market share there in the luxury department store space. Yeah. And also, if you look at Nordstrom, Nordstrom is not really expanding either. It's opening mostly rack stores now. So there isn't really huge competition in that area.
All right, David. Great stuff as always. One of the best in the business. MorningStar senior equity analyst David Swartz. A closer look at Macy's. When we come back, Rohit Chopra joins the program. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic. We've been talking a lot today about what's been going on in the retail space as the holiday shopping season is underway, and it's putting a renewed focus right now on the health of the consumer and affordability. Our next guest argues that more affordable holidays are, quote, just a pen swipe away, but it would actually require the Trump administration to eat some humble pie. In her latest piece for Bloomberg Opinion, she focuses on affordability as a bipartisan concern, one that this administration was elected to fix. Pleased to say joining us right now is non-resident fellow in economic studies at the Brookings Institution, Abby McCloskey. And we should point out that she's been a long-time policy advisor and policy director, including for several presidential campaigns, including Rick Perry and a few others that I'm sure I'm forgetting. Howard Schultz, too, who I also forget actually ran for president. But Abby, one of the reasons I wanted to talk to you is, you know, when we had the election last month here in the U.S., and it was obviously sort of a shoulder election, if you will, not one of the main ones. One of the things that came up in Virginia, in New Jersey, in California, was this idea of affordability. Whether you were polling a Democrat, whether you were polling an independent or a Republican, they all seem to be saying the same thing. And I am just curious, when do we start to see the folks in Washington understand the bipartisan concerns out there in the real world and translate that into bipartisan action in Washington?
Yeah, I think they're starting to see it. And that's why you have the tariff rollbacks on things like beef and coffee and household goods. And there's been a lot of carve outs to the tariff regime along the way. It's been a moving target. But what's easy to forget is that we remain under the highest tariff level that we've had in almost a century. And that impacts things especially like retail, toys, food, all the things that households are stocking up for this holiday season. I think the administration heard loud and clear what happened last month in the elections. There's been chatter about everything from, well, putting more money into the Trump accounts, which we heard about yesterday from Dell, to having some type of tariff rebate check. But the thing is, when people elect a Republican to the White House, to Congress, they expect an economy that works and inflation to go down. Mm-hmm. And the reason things are as elevated as they still are is an unforced error on the tariffs.
Well, I am curious about that, though. I mean, yes, I think we can all agree it's an unforced error, but it was also a big pillar of his economic strategy. He made that clear. I mean, he certainly campaigned on the idea of affordability, but he also made it clear coming in that he was going to use tariffs as a cudgel to force other policy issues that he wanted to address globally.
No, that's right. Although it wasn't ever for a specific end like that. I think he just has a strong protectionist streak, and there's that in his administration, irrespective of kind of towards what ends. And you're right that it shouldn't be, voters were not gaslit that this is an administration that prioritizes tariffs. Nevertheless, again, I just think when you look back at the first Trump administration and the good economic vibes, you kind of go into this one and you think, surely it's going to be more of the same. We're going to have tax restraint, regulatory restraint. We're not going to do things, whether it's a clawback of immigration or tariffs that are going to really shake the ship, and that's what's happened. So yeah, no one was gaslit. Yeah. People knew this was coming, but I don't think in our lifetime we haven't seen tariff levels like this, and so I think it's actually really hard to anticipate what it will feel like for the average voter.
So I am curious with regards to the average voter as we head into the midterm elections, and we're already getting into that season now with some of the primaries just around the corner. So are you hearing this from candidates on both sides, that not just that that's what they're hearing from their potential constituents, but that they are actually campaigning on some sort of fix or some sort of approach to addressing it?
Sure. Yeah, definitely. I mean, when you look at all the polling of what do voters care about most, the economy tops the list. Second behind it, or sometimes above it, is political dysfunction. And so I think we're going to see both sides running on that. The problem that we get into on the affordability piece is because things are still so much better than they were during the Biden era, I think that people on the left can inflate how much trouble this tariff problem is going to actually end up costing Trump in the ballot box or Republicans in the ballot box. Because even though things are bad now, even though they don't have to be this way, Trump could create more carve-outs of the tariffs or reduce them entirely. Yeah. It's better than it was last year at this time. And for a lot of people, that is going to be the standard that they hold this administration against.
All right, Abby, really great to catch up with you. Abby McCloskey there, former domestic policy director for multiple presidential campaigns, also an opinion columnist for Bloomberg. A great column today here on the affordability issue. And our next guest was actually just tapped by a Democratic group of state prosecutors to lead their efforts to address the high cost of living and other concerns related to it. Joining us right now is Rohit Chopra. He's the former director of the U.S. Consumer Financial Protection Bureau and newly minted senior advisor of the Progressive State Leaders Committee's Consumer Protection and Affordability Working Group, a long title and honestly a long list of issues that you've got to address. I just want to point out there was a recent Ipsos survey that went through all these sort of different demographics out there, voters, and asked them what their number one concern. Across the board, it didn't matter. Democrat, Republican, black, white, evangelical, old, young, middle suburbs, urban areas. Number one on everybody's list was affordability.
That's right, and it's not just affordability of one product. It's healthcare, it's housing, it's the cost of food, it's the cost of electricity so much. And we have seen the federal regulators in Washington basically shrug, in some cases not do anything. We have seen no activity by the CFPB, FTC, others on this issue. And so the state attorneys general are now going to be the chief regulators of much of the economy and are going to have to take a lot of actions to crack down.
So explain to me how that works. I mean, you mentioned CFPB, which for all intents and purposes is dead under this administration. You know that. FTC has been hobbled. What can the states do to fill that hole that has been sort of left by the federal government?
Well, one of the things we've already started to see is the state AGs are already challenging illegal actions by the Trump administration, whether it's the illegal tariffs or other actions. But they also have all sorts of state and federal laws that they can enforce. That means it can apply to banking, to healthcare, to food, so much. So they have asked me to help lead what is going to be the way that they fill that gap. It will not be a replacement, and the federal agencies should be doing their job, but they're not. And so we're going to see how these state tools can be put into practice to lower the costs of so many of these items that are busting the budgets of families.
So are these states working collectively, meaning that as they sort of make these decisions, will it be something that all these states agree on to do together, or will it be one state says, okay, we're going to do this, and New York or some other state says we're going to do something different?
Well, it could be everything. It could be groups. It could be all of them. It could be individuals. Just take a look at what we saw this week, a coalition of state AGs really starting to kick the tires on buy now, pay later. The buy now, pay later companies were under close scrutiny by the CFPB when I led the agency, but now there is no one in Washington who seems to care. This Cyber Monday and Black Friday, buy now, pay later surged in use.
Yeah.
And there are real signs of strain that people are not able to afford their holiday spending.
Two issues, though, when it comes to affordability. One that was really prominent during the most recent local elections that we had last month was energy prices and the idea of AI data centers moving into these communities, sucking up grids that were already sort of strained. And now, at least on a wholesale level, you're seeing a big spike in prices in certain states and communities. Is that something, I would assume the state and local governments would have a lot more power to sort of address that immediately, right?
Well, in many cases, these state regulators are the ones who get to sign off on rate increases, and the utilities have asked for roughly $50 billion in rate increases this year. We're seeing state AGs intervene to block some of those exorbitant rate increases, and in many cases to bring it down. I think electricity costs are ones that are biting people more than anyone expected, and the states are going to urgently act on it.
Housing affordability, a big issue, obviously in the city where we sit right now, New York City. The man who will be inaugurated as mayor in January, Zohran Mamdani, ran very heavily on housing affordability. I don't know what the solution is. He has a whole suite of solutions to address this issue. What can work realistically?
Well, there's going to be not just one, but it's going to be a whole set of things. And it's not just the rent or the mortgage payment. It's also the property insurance. It's also all of the other costs that go into affording a home. Right now, we have a situation where mortgage rates are still, and property values are still locking so many people out. People with existing homes feel they can't move because of the rate environment. And the Trump administration's policies, I don't think, no matter how much bullying they do of the Fed, it may not push down long-term rates. So you see the state attorneys general going after price fixing and collusion on that affect tenants and rents. You see them looking at real issues about housing developers. There's, I think, a long list we need to do, but unless we lower the cost of housing, we're going to continue to see consumers and households really struggle with debt.
All right, Rohit, really appreciate you taking time for us. Rohit Chopra there. He's the former director of the Consumer Financial Protection Bureau, now an advisor of the PSLC's Consumer Protection and Affordability Working Group, seeking to address what we've been talking about here, at least for voters, a bipartisan issue when it comes to affordability. We'll be back in a moment. This is Bloomberg. Time now for our stock of the hour, taking a closer look at Netflix. The share is down more than 5%. Netflix's reported edge in the battle for Warner Brothers Discovery really putting that stock under pressure. Investors worried about a deal worth potentially north of $70 billion might actually be a little bit too costly and, quite frankly, a bit of a distraction for the leader in the streaming space. Bloomberg Markets correspondent Norah Mulinda joins us right now to talk a little bit more about this. I was actually surprised at that initial reaction we saw in Netflix shares when we learned what they were potentially bidding. And then I was also surprised to realize that Netflix is down like 20% from its all-time highs.
I know.
So it's been under pressure for a while. What's going on?
You pinged me about that, and that surprised me as well, because if you look on a year-to-date basis, we're looking at a stock that's up about 17%. We know that this is the biggest streaming service provider in the world. It's really been on a tear, but as you're pointing out here, we are seeing more than a 20% drop from its June peak here. And if we think about the activity that we've been seeing in the trading day today, what I've been hearing from analysts, had to make some calls, of course, about what's going on. They're essentially saying that investors feel as though this is a distraction for Netflix. This deal, of course, between Netflix and the proposed bid for Warner Brothers Discovery, their streaming service, as well as their studio business there. And they're thinking that, this is a company that already has so much content. They have, more than 320 million subscribers. And if they were to get this deal across the line, this essentially is game over for the rest of the media space right now. But they think that this isn't necessarily a necessity here for Netflix.
And I think that's been the concern. Just real quickly, 30 seconds though. There's all antitrust issue as well. And by antitrust, I kind of put that in quotations marks with this administration. I mean, the betting always seems to be that one way or another, this is going to end up at Paramount Skydance because of the Ellison's relationships with the Trump.
And that's what the conversation has been. But as you mentioned, antitrust concerns still continue to be something that people are thinking about in this time period, because this would actually make them just a massive conglomerate here. And we'll have to see where it goes from here in terms of who is able to see it across the finish line.
Netflix under pressure as we move closer to the closing bells. Norah Mulinda, our Bloomberg Markets correspondent. Stick with us. This is Bloomberg.
Ultimately, though, what we're focused on is, what is the use case for AI? And if we're going to completely replace something like yourself and myself, we're in the very beginning innings, or are we just going to be leveraging it for productivity? And I think that question remains. Is why so many people are bringing up the topic of bubbles. It's just there's risks in the system, and we need to be thoughtful around it.
Alexandra Wilson-Elizondo kicking us off to the close a little bit earlier over at Goldman Sachs Asset Management on a day with the S&P up for a second straight session. Fractional gains to be sure, but you take a look at the tape at 68.55 and change, just about 25 points away from its most recent all-time high set back at the end of October. Leading the charge today, though, surprisingly, it's actually not big tech, if you will. You're actually seeing a lot more activity in some of the cyclical names and in the banking stocks. KBW Bank Index up more than 2% here on the day. Some of that tied to what we've been seeing, the moves we've been seeing in the Treasury space. But also keep an eye on commodities. Copper futures over in London at one point on the day, hitting a fresh record high. As we move closer to the closing bells, just a little bit less than 9 minutes to go. A lot of questions right now, not so much about what happens over the next couple of weeks, but more importantly, whether this rally extends into 2026 and beyond. Elena Hernandez joins us right now. She's a managing director and a senior client advisor over at GenTrust. And Elena, I do want to start there with portfolio positioning. Coming out of a year, which was a phenomenal year by any stretch of the imagination. A lot of people sitting, at least in public equities, on some pretty healthy profits that they haven't already cashed in already. But also some big questions about whether you continue riding the winners from 2025 into 2026.
Yeah, absolutely, Romain. Just like you said, it's been a great year for investors in truly diversified portfolios. And when I mean truly, I'm referring to not only diversified from an asset class perspective, but also from a geographic perspective. As you know, the U.S. market S&P up 16% on the year. When you look at global markets, around 20% up on the year. If you look at Europe, up 28%, Asia up 27%. Emerging markets up 23. Of course, those have benefited from the sell-off in the dollar, right? And that has benefited those markets. But it also shows you, again, the importance of having true diversification. In terms of going into next year, there are a lot of uncertainties that we're watching, like you said. You've seen, and you mentioned, the turnaround in terms of, from October 28th to now, how the Max 7s or the big AI trend that was carrying the market has a little bit reversed. Now we have other companies that are the ones that are helping rally the S&P. We are watching a lot of the uncertainties in the markets right now, such as tariffs and the final Supreme Court decision, even though I know Treasury Secretary Bain today mentioned they could still probably charge the tariffs through the trade deals. We're watching what happens with the Federal Reserve. We think definitely next week there'll be a cut, but what happens, going forward, as well as what happens with the AI, trade, et cetera.
Well, I am curious, Elena, too. I just want to just go back just one step here, particularly when it comes to this idea of geographic diversification. Obviously, the dollar weakness was a huge part of the story. In fact, to a certain extent, it helped to boost, actually, U.S. assets, but obviously it had a big impact on assets overseas, particularly in emerging markets. But coming off a year, I think last time I looked, at least based on the Bloomberg Dollar Spot Index, we're weaker by something like 7% on a year-to-date basis. And other than in 2017, I can't remember the last time we had a year like this, certainly not in my career. And I am curious as to whether you think that weakness does actually extend. Is this the start of a long-term, meaningful structural shift lower for the dollar relative to its global peers?
It's a very good point, Romain. We're actually doing a lot of analysis internally at GenTrust regarding this, just because we are kind of at the place where, it's been about 18 years in this dollar bull cycle. And there's been 4 components that we watch very closely that are the ones that usually carry us through the different cycles that we've had, if we look back since, the 70s on this. One, geopolitical risk, which of course have increased, particularly with the implementation of tariffs, tariffs that are on average around 15%, 90-year highs of what we've seen. Interest rate differentials. The U.S. over this last 18 years has had, higher rates than the rest of the world. But now, not only with the situation we have with the labor market, we saw the ADP numbers this morning, weaker than expected, and, the 4th out of 6 months with a weaker job report. But also, considering other economies like Europe, like China, like Japan, might also start recovering, that interest rate differential might become lower, which is another reason why people invest in different currencies. Then you have the issue of the deficit, right? And the concern, particularly after the passing of the One Big Beautiful Bill Act, and what that does to our fiscal position. Ideally, that was supposed to be, taken aback or being supported by tariffs on the other side, but we'll see what the Supreme Court decides on that. And then you also have investment flows, which the U.S. has really, really benefited from all these AI wave and investment flows coming into the U.S. because of technology and all that. So we're watching that closely to see if we're actually indeed entering a dollar weakness cycle going forward.
I am curious when it comes to the idea of sort of, if not hedging, sort of diversifying amongst other asset classes, so outside of public equities. Does fixed income, and specifically I'm talking about either investment-grade corporate bonds or treasuries, is that still a meaningful allocation to your portfolio?
Yes, absolutely. So at GenTrust, we believe in, both, like I said at the beginning, asset class and geographic diversification. So we do have allocations for our clients throughout different asset class, like fixed income, like real assets as well, and municipals, et cetera, when depending on their tax condition. But to speak about fixed income, we are still invested in fixed income. We came in the year long duration, and we moved into credit around April. But now we pare that back in terms of the credit markets and kind of the concerns of, overvaluation also, and seeing spreads tighten significantly, right, over the last couple of months. We decided to pare that down. So we're back on a treasury or a cleaner kind of rate and long muni position right now, as well as we still have, obviously, in our real asset bucket, gold and uranium, which have been great performance this year. We took some profits, but I'm still going to keep those long term.
All right, Elena, great stuff. Got to leave it there. Elena Hernandez, Managing Director, Senior Client Advisor over at GenTrust, counting you down to the closing bells. Just about 2.5 minutes to go until we get there. The S&P is in the green today, just like it was yesterday. But unlike yesterday, the majority of the stocks in the S&P 500 are in the green. We had the flip-flop of that yesterday, and that caused some people a little bit of concern. 330 names moving higher on the day, and that includes some of the big cap names, like your Alphabets, like your Teslas, like your Palantirs. That's good. You're also getting a strong bid out of names like JP Morgan, helping to lift the market. But a lot of those cyclical names also getting in on the action, including in healthcare and in consumer staples. That could maybe be the secret sauce. A full breakdown starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here, taking you through to that closing bell with the global simulcast. Joining us right now from the radio booth is Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. I hate to tell you this, Tim. We had to fire her. Sorry.
Wait.
No, that's a joke. I'm sorry.
I thought Matt Miller was
She's on assignment today, so Katie will be back in a couple days.
Okay,
Don't
she's
worry.
back in a couple days.
No, we love Katie.
I thought Matt Miller was going to be with you.
So we take a look at the markets here today, and we talk about a market that is still sort of clinging to,
chilly in here,
modest gains. But we talk about 2 straight days of gains, and S&P actually not far off from reclaiming its record high. But this isn't the sort of meaningful all-in, the pool oomph that we saw earlier in this rally cycle.
Yeah, not a lot of oomph, if you will. But we will say there's more names in the S&P that are actually gaining some ground today. But it's kind of a weird market. I keep going. I think we're just waiting. Want to hear from the Fed, what insight they have into 2026, and kind of where we go from there.
I just want to prove I don't only talk about cryptocurrency when it's down. Bitcoin today up 1.5%, above 92,000, close to 93,000.
Equal opportunity crypto person.
Yeah, we've been keeping a close eye on it, so worth repeating.
Interesting to see that trying to bounce back, trying to reclaim some of that magic. 2 interesting stories, though, to keep an eye on. Not a whole lot of movement in rates, but a huge downdraft today, once again in the dollar. And then also, you're seeing a huge bid higher in a lot of the bank stocks today, which also seems to be tied to what we've been seeing in the yield space here. As we head into next week, a week from today, where we finally get that Fed decision that most investors seem to believe will include a 25 basis point cut. The closing bells here in New York, and it does appear to be green across the screen, across the board. The Dow Jones Industrial Average up about 0.9% here on the day. The S&P 500 adding about 21 points, or about 0.3%. The Nasdaq Composite only up a smidge, and this is actually the story here. Big tech, the big laggard on the day. The Nasdaq Composite and Nasdaq 100 each only up by about 0.1 or 0.2% here on the day. But your outperformers on the day, and this should maybe provide some sort of comfort. Dow Transport's up 2% on the day, and the Russell 2000 up 1.9.
Wow, some significant outperformance there. Hey, let's go back, though, to the S&P 500. I mentioned most names in the index higher today, 337 to the upside, remain 165 to the downside, 1 unchanged.
And of course, we talk about sort of what led that charge. It was energy, it was financials, it was industrials, it was consumer discretionary, all posting pretty sizable gains here on the day. But the big laggards on the day, you saw that in communication services, which is largely a lot of the companies like your Metas, if you will. You saw that in utilities, and you saw that in the S&P Infotech Index, which includes all the biggies, all those biggies here, down as a group by roughly about 0.4%. Now, speaking of the biggies, Carol, we are getting some earnings right now out of Salesforce.
Yeah, we are indeed. So let's go through the numbers, folks. Let's go right to the forecast. Salesforce seeing fourth quarter revenue, $11.13 billion to $11.23 billion. And folks, that is easily above the street estimate. And that's probably why you're seeing the stock up about 6% here in the aftermarket. $10.91 billion is the estimate. Let me go back to the third quarter. Third quarter adjusted EPS, that was a big beat. $3.25 a share versus the estimate of $2.86 a share. Also, if I take a look at third quarter revenue, that was pretty much in line, $10.26 billion versus an estimate of $10.28 billion. But again, all right, so pulling back a little bit on the gains, but remains still up about 4.7%. So investors liking what they got in terms of that forecast.
And I just want to stay on Salesforce for just 1 second, because there was some concern, you guys, coming into this morning with that report from the information about apparently Microsoft's salespeople had missed, at least in the first half of the year, some of their AI sales targets. That actually led to a downdraft in both Microsoft and the broader market. Microsoft pushed back on that, and we saw a big bump up. So there are a lot of concerns about what we would hear out of Salesforce. This also comes on a day where we heard from the Anthropic CEO at a New York Times event saying that he thought some of the spending on AI had maybe gotten a little bit too risky, and some reports out of that Morgan Stanley was actually looking to do a strategic risk transfer in some of the loans tied to that data center build out.
Yeah, just back to Salesforce and staying on Salesforce, up 8.3% in the after hours. Revenue for the fourth quarter, the guidance beat the average analyst estimate. Fourth quarter forecast sees revenue $11.13 to $11.23 billion. That's ahead of estimates of $10.91 billion. The estimate for adjusted EPS was for $3.03. That coming for $3.02 to $3.04, so right in line with estimates. The company sees the current remaining performance obligation up at 15%.
Yeah, we're going to dive deeper into this, but yeah, on the surface, these numbers look pretty good. It'll be interesting to see what the Mark Benioff and his team has to say on the call here. The idea of AI adoption, and of course, a company in Salesforce that is really bet the farm on it going forward. Meanwhile, we are getting some other earnings. This out of the retail space, Five Below, the retailer out with its earnings, and it does look to be a beat and a raised quarter. The shares had a decent little pop just a few minutes ago, pairing some of those gains. The company saying that in the most recent quarter, net sales did come in up about 23% at about $1 billion even. That's above the average of analyst estimates. The company guiding for the next quarter, or the current quarter, the fourth quarter right now, seeing a guidance of net sales in the range of 1.58 to 1.61 billion. The low end of that range is above the average of street estimates. Similar story, Carol, when it comes to the EPS range, with the low end of that range higher than the average of street estimates.
So important in terms of what it's telling us about the U.S. economy, the consumer, the retail reads. I want to go back, though, to Salesforce, if I may. We've got a great write-through on the Bloomberg by Ardina Bass and Brody Ford. Again, the company giving an outlook for revenue in the current period that topped analyst estimates, suggesting the software company is persuading customers to buy its AI tools. The company's AI tool, it's called Agentforce, has closed more than 9,500 paid deals since its launch, with the annual recurring revenue for the division that includes AI-focused tools being $1.4 billion in the period ending October 31st. So again, that AI trade remained mentioned, like some concerns maybe heading into these earnings, but it looks like Salesforce is definitely delivering, Tim.
Yeah, Mark Benioff calling out that 9,500 page Agentforce deals. He also says 3.2 trillion tokens processed. Some other numbers that he highlights in the press release, and of course we'll get more potentially on the earnings call, raising the fiscal year 2026 guidance, signaling a powerful pipeline of future revenue. Agentforce and Data 360 products, their momentum drivers, hitting nearly $1.4 billion in annual recurring revenue.
Yeah, we should point out, coming into this session, actually one of the worst performers in the Dow Jones Industrial Average on a year-to-date basis, and that caused some concern here. But at least the customer relations software company looks to get its mojo back. Meanwhile, we want to take a look at some of the database architecture companies, and that includes Snowflake. It's just out with its results right now. Those shares actually moving lower, down about 5% here in the after-hours trade. Here's what the company has to say with regards to the most recent quarter. It basically says that in the most recent quarter, revenue did come in line with estimates at about $1.16 billion, EPS at 35 cents. That's about 4 cents higher than what the street was looking for. For the fourth quarter, the company says, though, that product revenue will be in a range of 1.2 well, there is no range. It will be $1.2 billion, and that's basically on the nose of what the street was looking for. The company also says full-year product revenue, 4.45. That's slightly higher than what it forecast before, but only a smidge higher than what the street was looking for. And maybe that's why you're seeing some softness in the shares.
I'm looking at another company reporting after hours. AI US is the ticker, C3 AI. It's the application enterprise software company. Shares bouncing around in the after hours, but down 2.8%. In terms of the numbers, C3AI second quarter adjusted loss per share of 25 cents. That came in ahead of estimates at 33 cents. The company sees fiscal year revenue 289.5 to 309.5 million. That's very much below what it saw earlier, which was 447 million to 484.5 million. Second quarter revenue came in above estimates at $75.1 million. Once again, and now actually the company sees the third quarter revenue 72 to 80 million. The estimate was for $75.6 million. Shares in the after hours down about 1.4%.
All right, so seeing a lot from certainly the tech community. I want to go back to the retail community. Five Below, remain breaking it down earlier. This is a stock that's up almost 60% year to date. The stock now up about 1.5% in the aftermarket. So it's been bouncing around a little bit. Going to the outlook, the company seeing fiscal year EPS of $5.51 to $5.69. It had seen $4.56 to $4.96. The estimate was below $5. Yeah. So it looks like investors certainly feeding into that one and liking it remain.
And this raises a lot of questions. We're basically through the earnings season. This is it. We get a few tomorrow, like Dollar General and Hormel, and I think DocuSign and HPE, Ulta Beauty as well. But we've kind of got the read now on what's going on with business spending, what's going on with consumer spending. The quarter's over. And it looks like overall it did better than what most people had thought.
Yeah, I think you're right. But I have to say, when it comes to retail, like you guys, we've done a lot of interviews on that. And it just feels like everybody talking about the consumer, yep, spending, but being cautious. So anything that puts any more additional pressure on a consumer, I think we could see some problems. And we'll see whether or not they get an assist perhaps from the Fed in lower rates and how that can trickle through certainly the economy.
Yeah, just a reminder, like the big picture that we've gotten from these retailers has been this bifurcated consumer where the high-end consumer is still spending and even the middle-income consumer is trading down. And look at what we saw from some of the dollar stores as a result.
Five Below, up about 2%. You've got Salesforce guys up about 4.5%. Snowflake right now down about 6.5%. So watching all of this here in the aftermarket. That is a wrap. Please find Katie Romain. No comment?
I think we lost Romain. Where are you?
All right, that is a wrap. Our cross-platform. Romain finishing up there on the close on Bloomberg TV. I feel hurt. Tim and I continuing here on Bloomberg Business Week Daily on Bloomberg Radio. We will see you same time, same place tomorrow.
Our coverage continues here on Bloomberg Television. From public markets to the private, David Sambur, partner and co-head of private equity over at Apollo, joins us in just a second. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A green day here on this Wednesday afternoon for U.S. equity markets. The S&P 500 adding about 0.3%. That may not seem like much, but right around that 6850 mark here, it's only about 20 to 30 points away from its most recent all-time high. But it was not big tech that actually did the heavy lifting today. It was actually a lot of the cyclical stocks as well as a lot of the bank stocks. A big move higher in J.P. Morgan as well as a lot of the other banks that helped to lift the KBW Bank Index up by about 2% here on the day. Meanwhile, you take a look at some of the tech stocks. Of course, we did see a lot of weakness here in Netflix. We talked about it a little bit earlier, a 5% drop today that now takes its drawdown from its all-time high down to about 22%. We're basically talking about a stock in bear market territory. Some of this started weeks ago, but the real catalyst over the last few sessions has been the speculation of its bidding for Warner Brothers Discovery's assets. Microsoft down about 2.5% on the day. It was down a whole lot more than that earlier in the session. Some concerns about that report out of the information. And we just got results out of Salesforce, at least so far. Heading into the tape here, it actually closed higher by about 2%. And those shares seem to be going a little bit higher here in the after-hours trade. And that does bring us to our top story, a focus on the tech trade and the renewed jitters around whether demand for AI products actually matches the investments in AI infrastructure. That story on Microsoft missing some AI-related sales targets, that rattled folks a little bit earlier. But remember, it was 3 months ago when Salesforce did the same. That's when it said it was taking time for large businesses to feel comfortable implementing AI tools. So here we are 1 quarter later, and what does Salesforce have to say? Well, it looks like some of that implementation finally does seem to be picking up. Still, investors are out there searching for evidence of deeper AI adoption, and it raises a question as to whether we've actually been looking in the wrong place. David Sambur is the co-head of private equity at Apollo Global. Years ago, he began to intensify the focus on equipping his firm's portfolio companies with the digital and AI tools necessary to generate value. It's been part of a broader transformation of the traditional PE model that, under his watch, is putting greater emphasis on the quality of returns. Pleased to say, David joins us now here in Studio 2. David, great to see you.
Good to be here.
Talk to me a little bit about that. Not so much just about AI specifically, but how you sort of make your portfolio companies more resilient, particularly in a world, I mean, at least certainly this year, that is just changing so fast.
You know, the pace of change is increasing and change is a constant. When we think about our portfolio companies, you know, there's a lot of ways to create value. We're looking to avoid mistakes. So when you talk about AI, one of the biggest things to focus on is making sure that you don't buy a company that is at risk of being disrupted. So much of our value prop is making these companies grow faster, be more profitable, and deploying technology even before ChatGPT got released, and it was just 3 years ago. There was AI before that. We've been bringing together experts to help our portfolio companies deploy best-in-class technologies to grow faster and be more profitable. And it's literally all we talk about right now.
I am curious, though, just about the general structure of how you sort of manage your business. I mean, we've talked a lot on this program about the state of the PE industry. We joke whether the PE industry is dead or just, kind of, taking a little bit of a breather. But when you look under the hood, there's still been a ton of activity, a ton of at least internal returns for the companies that are managing that money. What is the state of PE right now?
I'd say for the industry in general, it's reaching a critical pivot point. And that pivot point, I think, started in 2022 when rates spiked. If you look at the period from the GFC to 2022, 99% of private industry rates of return were driven by multiple expansion and revenue growth. That's not private equity. That's levered beta on steroids. And when rates rose, people had to get back to doing what PE was before rates got so historically cheap, which is buy a good company at a reasonable price, make it grow faster and be better through using technology and otherwise, and then exit it thoughtfully. And that's the most important point. LPs are dying for distributions. Post the interest rate spike, the industry's been returning capital at about half the rate it did historically. And that's the whole purpose of our model. It's to return capital to investors. I think a lot of people just got lazy when the job was easy, and people got to get back to doing the hard work that you get paid to do to make these companies better.
Where are you finding opportunities right now, new opportunities?
So for us, we're first of all, we've been very active. You talk about where the industry is. This is actually the most active year we've had in the history of our business. If you think about this year, it's been a crazy year where people went into the beginning of the year expecting there to be a tremendous amount of M&A that didn't materialize because of Liberation Day. And then the second half of the year has been a pickup in activity for the industry. We put out almost $10 billion of capital this year, and it's been one of the busiest years in terms of returning capital for us as well. Where are we finding it? We're finding it in all different places. We're finding it in public markets. We're a big buyer of public companies because, simply put, I think the public markets aren't functioning for non-technology companies, so we're a better owner of those companies. And we're finding it in corporate carve-outs, whether it's buying Yahoo from Verizon, which we did in 2021, or whether it's buying Panasonic Automotive from Panasonic, which we did at the end of last year. We're seeing corporations want to simplify their businesses and partner with someone like us that could apply capital and know-how to make these underperforming businesses perform better.
With that type of deal activity, are you seeing a lot of sort of public on public type of deals, or is it kind of a public company buying a private company? What are you seeing?
I think if you're not an AI company, it's unclear that there's a home for you in the public markets. You're talking about 7 companies that have driven almost half of the returns over the last 5 years, and approximately 40 companies are 75% of the returns. Earlier in my career, you could take industrial companies public, packaging companies public. It's not clear to me the public markets want or care about normal companies. You have a world now where 90% of companies in America over $100 million are private. Every year, more companies are removed from the public markets than are redeposited back into the public markets. And I don't think that trend is changing. I think that's a long-term secular trend. Despite the fact that the value of the public markets is as high as it's ever been, it's a narrow, concentrated, ever-shrinking public market in terms of the number of companies and the breadth of industries. And that's an opportunity for us as a buyer.
Where's the opportunity for investors, meaning the investors who are looking at public markets and realizing there aren't a whole lot of options, or at least not the breadth of options that maybe they want, and then they look at the private markets and they see all this activity. How does that expand in terms of giving people more access to that?
I think that's why people are really asking themselves, how could you expand access to private equity? And it's certainly something we think a lot about as a firm. We want to make sure that it's not just the same products that are offered to institutional investors that are offered to individual investors. They have to be different products with different risk profiles, perhaps lower risk, lower volatility, with different liquidity profiles. But because the returns have been so good for so long versus public markets, because public markets now, it's not even clear what purpose they serve. I can understand why people are so focused on the private markets.
Before I let you go, I do have to ask you about your boss, Mark Rowan. He wrote a very impassioned column today for Bloomberg, which I'm sure you saw, and I'm sure everything he wrote in there, you've probably heard from him a million times behind closed doors. It was a pretty full-throated defense, specifically on private credit. But the idea, and it kind of addresses some of the issues you talk about, the idea of what the quality is in there at a time where everybody's sort of trying to look under the hood and saying that what's going on in private credit is somehow just some sort of ticking time bomb.
I think Mark said it well in his op-ed. There are good loans and bad loans. There are good underwriters and bad underwriters. There are good equity investors and bad equity investors. We try to be the good type. If you think about it, there's been private lending going on in America for 250 years. It's only been a brief moment in time that there's been so much public lending in America. And I think Mark said it well, that there's a lot of misunderstanding going on in the marketplace. And in fact, these loans are often the most heavily diligenced, the most well underwritten loans. And private credit means more than just levered lending. And a couple of the blowups that people have talked about, the two that he referenced in his article, those were bank underwritten loans that were levered lending. And when we say private credit, we really mean the investment grade private credit, the much bigger, lower risk ends of the market.
All right, can you tell him to write more columns for us?
He's good at it.
He was, and you can write for us too. David, really great. Obviously, you guys just one of the best in the business out there. David Sambur, partner and co-head of equity over at Apollo. Some breaking news, more earnings. This out of PVH, the apparel maker. Out with results here, a beat, modest beat here on adjusted EPS and on revenue guidance going forward, 320 to 335 a share, slightly below the average of street estimates. We'll be back in a moment. This is Bloomberg. All right, whatever concerns we had this morning about the pace of AI adoption, a bit of relief here. Microsoft pushing back on that report from the information earlier this morning, and Salesforce earnings just out, a strong revenue outlook, and more commentary here that the AI adoption curve continues to arc. Dan Ives joins us right now, Global Head of Technology Research over at Wedbush Securities. Dan, when you start to see people get jittery about the AI spend, whether it's enough, whether it's too much, whether there's any real return, when you see the results out of Salesforce today, as well as some of the other companies this cycle, what does that tell you?
Validation movement. I mean, look at MongoDB as another one, right? And you saw it with CrowdStrike on the AI side as well. Look, Rohit, I think what you're starting to see here is the second, third, fourth derivatives. They're now playing out with the AI revolution. That's going to be the theme 2026. This is, I think, just more and more momentum, especially on the software use case side going into 2026.
This gets to this idea then. So when we start to talk about the adoption by the customers themselves, the clients, if you will, the companies that are selling this stuff, so whether it's whatever Microsoft's doing, whatever Salesforce is doing, does that ramp up or are they already at sort of warp speed on this?
Only 3% of companies in the U.S. have gone down the AI path. I mean, it speaks
only
to
3%?
our view.
Wow.
Only 3%. And it speaks to our view that, like, when you call this a bubble, it is way premature. Look, if someone like myself spends so much time, on the road, I just saw it in Asia for 3 weeks. Demand to supply is, 12 to 1 for NVIDIA chips. This hasn't even happened globally. And guess who's leading in the global race? It's U.S. is leading China when it comes to tech. So to me, the use cases now start to play out, the derivatives, the second, third, fourth, derivatives are playing out. And that's the key. Look, that is the key theme that we're seeing from Marvell to Mongo to Salesforce, I believe to Snowflake and others.
I'm curious, too, just about on the chip side of this as well. We heard from Jensen Huang a little bit earlier today. He was on Capitol Hill meeting with senators, trying to address this issue with China and being able to sell there. Does China become a market for us, at least for U.S. companies, at some point?
Oh, yeah. I think you can talk about the Trump visit in April and then probably reciprocal here. It's a matter of time. I mean, we are not going to give that market to Huawei and take it away from NVIDIA and what I believe U.S. chips. And that's what the godfather of AI, no one has a better perspective of what Jensen's seeing. You don't want to give that market to Huawei and domestic competition. I think that's what's going to continue to play out in this arms race. That will be part of NVIDIA's growth story over the next 12, 18, 24 months. I think it's all part of this game of high-stakes poker going on between D.C. and Beijing.
I am also curious about the partnerships, and they continue. We did hear just a few minutes ago from Snowflake strengthening that partnership with Anthropic, basically integrating those Claude models deeper into the platform. Does that accelerate as well, Dan?
It has to, because in this arms race, that's what everyone's focused on. Put stakes in the ground, whether it's NVIDIA, OpenAI, Snowflake, everything Lisa Su's doing, AMD. Look, they could get criticism for it in terms of some of the circular financing and other issues. We're talking about $3 to $4 trillion that's going to be spent in the next few years. This is not the time to look at this from sort of the back seat. It's the time to be aggressive, and that's what investors want to see. And I think we are going to look out. It's why we think tech stocks are up another 20% next year. But the bears will watch this AI party through the windows. It's still 10:30 p.m. and that party goes to 4 a.m.
Yeah, and let's remember, there are a lot of people that don't actually show up to the party to midnight. Not me. I'm a I get early and leave early, but you, Dan, you're, of course, the world traveler. Always great to have you here, man. Dan Ives, Global Head of Technology Research ever at Wedbush Securities. A closer look at the earnings that we just got out of Salesforce. Those shares are higher in the after-hours trade. Meanwhile, Snowflake taking a little bit of a dip down about 7%. When we come back, we're going to stick on the theme of AI, but talk about it through the lens of the retail customers. All those agents that are helping Salesforce, well, they might actually be able to help the rank and file consumer as well as they're out there doing their holiday shopping. Leah Johns over at Bain & Company is going to be joining us when we come back after the break. Stick with us. This is Bloomberg. AI is front and center with earnings out today from Salesforce, from Snowflake, from C3 AI. But there's a recent report out from Bain & Company showing usage of generative AI is rising in the U.S. with almost 70% using the technology in their personal lives. And trust is actually high, with more than 50% saying Gen AI will give accurate answers and accurate information. Joining us right now to talk a little bit about these findings is Leah Johns. She's head of Bain & Company's Consumer Lab. And Leah, I'm really intrigued by this because I guess depending on who you ask, either AI is the greatest thing in the world or it's going to kill us all. But there's this middle ground that I think we all intelligent people understand is there. And I want to talk a little bit about that, specifically as it applies to just regular folks using it. Is it just me going on and using a chatbot to plan my vacation or do something else?
Yeah, so, first, thanks for having me back. It's great to be here. What we're really seeing based on the study that we just did is a real step change in Gen AI usage. And to answer your question, it's everybody. So it's moved really from a curiosity or a novelty to a daily tool that people are using. 70% of people, as you just mentioned, in the United States have used Gen AI, most of those people doing it actively. The other really interesting fact is that the frequency is increasing. So 45% of people who use it are using it daily. And that's up 25% versus just 9 months ago when we did this research. So what we're seeing is an increase in use, an increase in frequency, and that really shapes the way that people are looking for information, including how they're shopping.
Well, let's talk about the shopping side of it for a second, and then I do want to circle back to another issue. With regards to shopping, how do you use it? And I'll have to admit, I'm a little ignorant. I've used it to plan travel. I've even used it from time to time to plan for an interview. But I've never used it to say, go buy a suit or shop for a gift for someone else. How do you do that?
Okay, so we can think about the entire shopping journey and the way that we get information. So first, you discover a product. You might compare different products once you have different products. You might compare pricing, and then eventually you make that purchase. And so what we're seeing is today, when we asked U.S. consumers who use Gen AI, 60% of them said that they use it somewhere along that journey. So it could be asking for the best makeup, for example. In terms of doing it end-to-end, which we call agentic shopping, so that would be the AI actually making the decision for you and doing that checkout, that is very small at the moment. But that top of the funnel is really big. 30 to 45% of people are using it to compare products, are using it for recommendations. And so what that means is where they're going to search is really different than it was even a year ago. So they're not going to that retailer website necessarily or to the search engine. They're going into AI.
Well, that actually brings me back to my other question and the idea of what the implications are. First, for the folks that are producing this information, in your report, you talk about this idea of zero click, the idea that if you're using an AI search, you're not necessarily going to then click through to the actual website the way you would on, say, a traditional search function that you ran in Google or Bing or wherever here. But does that create a problem down the road? If people aren't getting clicks on their website and they're not getting, in theory, any revenue from my AI searches, are they going to continue producing content that's relevant to me?
Yeah, I think you nailed it. So the search is getting changed in two fundamental ways. First is the zero-click search. So this means, you find what you need from that AI summary on the website, and you don't click anything. So yes, that has huge implications for anybody, any consumer-facing business who is trying to get their brand or their product out to a consumer. The second thing is that search engines are being replaced by chatbots. 15% of U.S. consumers tell us they always now start their search by using the chatbot instead of the search engine, and another 30% are splitting between the two. So it has huge implications for both retailers and brands in terms of customer experience, getting your product in front of people, and also paid media. because you're not paying anymore for a rectangle, let's say, on a website. You can't insert yourself into that conversation on ChatGPT because it's a captive platform. And so brands need to think about how else they're going to engage consumers if it's not done in that traditional way.
So I am curious, though, too. Let's just go back to the retail for a second. If I'm a retailer, so right now, I mean, the game is right now, it's through Alphabet or Anthropic or whoever's, Perplexity, whoever's supplying the stuff. That's the game right now. If I'm a retailer or just an individual company, can I sort of create my own sort of agentic AI chatbot in a way that it will be searched through me rather than going through a third-party search engine?
Yes, so we're talking to our retail clients about this today. And so there's kind of three options. You can build your own agentic agent, which some of the big retail players are doing. You could partner with one of the AI platforms, so OpenAI, and they've had partnerships that are publicly announced with other retailers, or you can do both, right? So you can build your own agent, try to drive traffic and conversation around your site, but also develop a partnership with an AI platform and ensure that that is done in a strategic way so that retailers still hold the asset that's really important to them, which is customer data at the end of the day, and hopefully keeping that purchase and fulfillment process. So yes, you can build your own AI agent, and you also have to think strategically about how are you going to partner with the platforms where people are going to search initially.
All right, Leah, well, you gave me a lot to think about, especially considering I haven't actually started my holiday shopping yet.
Good luck.
Leah, always appreciate you guys and everything you guys do over at Bain. Some great research out of that, some great insights. Leah Johns, head of Bain & Company's Consumer Lab there, as we take a look at some of the after-hours movers here on this Wednesday afternoon. Salesforce leading the charge here. A bit of a surprise. There were some dour estimates coming into this print today, but Salesforce putting some of those concerns to rest, a 5% pop in the shares in the after-hours trade. Oracle not benefiting a whole lot on the back of that. Five Below, which did report earnings, out, up about 2%. We'll be back in a moment. This is The Close on Bloomberg. All right, if you dig through the big banks' 2026 outlook, there's a good chance you're going to find the following keywords: AI, deal-making, rate cuts, private markets. Our next guest has a pro-cyclical bet on equities in the year ahead, expecting a mix of Trump policies and structural tailwinds to keep stocks afloat. Pleased to join us right now here in Studio 2 is Chris Toomey, founding member of Team Global in Morgan Stanley Private Wealth Management. Great to have you back here, Chris.
Thanks for having me.
Well, let's talk a little bit about this. What is a pro-cyclical bet? What does that look like in 2026?
I think it's kind of a continuation of 2025 in the sense that we're in a situation where a lot of these policies are going to start to see some fruition. So you've got fiscal policy with big, beautiful bill kind of getting implemented in full swing. You've got fiscal policy with regards to additional Fed cuts and then deregulation. So I think all of that is going to play out in 2026. I think the other thing that you're going to start to see is those continued animal spirits building in behind that, along with kind of a broadening out of the market. So, we've seen a fairly concentrated market. We're starting to see better breadth within earnings, and we think that's going to spread out into performance within the stock market.
A bit of a loaded question, but how much does the Fed actually matter in all this, the rate cuts?
I think it does significantly. Yeah. I think if you look at the degree with regards to concentration within performance, you also see that with regards to the general economy. So we are in a really weird situation where you have continued economic growth, you actually have pretty low unemployment, and a Fed that is kind of aggressively cutting. Mm-hmm. So that seems like a contradiction. In reality, though, if you look at kind of the average participant in the market, whether it's corporations or individuals, they're not necessarily doing as well. And a big part of that is how high rates are. And so I think that's part of the reason why the Fed is sensitive and leaning towards continuing to cut rates.
When you look at economic conditions, do they look stable to you? And more importantly, does it look stable in deeper into 2026?
I think they are.
Yeah.
I think, look, we're obviously concerned about the follow through with regards to tariffs, how that plays off with regards to inflation. We're starting to see unemployment ticking up a little bit. There was a little bit of concern in the sense that economic data was looking worse, and we went through one of the longest government shutdowns in history, so we weren't getting that economic data to tell us what was really going on.
Yeah.
And so I think that had something to do with the market pullback that we've seen over the last 2 months. That being said, you look at credit spreads, you look at balance sheet, you look at corporate balance sheets, all of those things look very good. Liquidity still looks relatively good in the market. And so all of that we think is going to follow through in 2026.
Well, I am curious. I mean, essentially, you mentioned credit spreads. We were talking with the guest earlier today over at Goldman Sachs Asset Management and about the idea that because of how tight credit spreads are, it's making some of those investments, at least in the investment grade space, maybe a little bit less attractive heading into next year. Do you have the same view?
Yeah, I think the opportunity set there is not as great. From a fixed income standpoint, we're probably more inclined for taxable investors to be in that kind of municipal bond space where I don't think it's participated as much in this kind of performance jump. Like if you look at our investment grade portfolios, they're up 7 or 8%, almost like an equity-like return, given rates coming down and spreads being really tight. So I get that. I think there's still opportunity in areas that are like fixed income, private credit, which is obviously a hot button topic. We still think there's value there. We also like areas within infrastructure and ABS as an alternative to traditional investment grade credit.
And this gets to the idea too. I mean, you use the word kind of the market broaden now, or at least in reference to the public markets. But we've talked with a lot of investors who've seen this broadening going on now for a few weeks, few months really, despite the fact that we spent most of the year talking about big cap tech and the chip stocks, et cetera. What sort of continues that sort of the cyclical bent, or maybe not cyclical, that's not the word I want, but the idea that you'll have something other than tech effectively, something other than AI that will not just get a meaningful bid, but could actually help to carry the market despite the waiting?
I mean, I think the main driver is going to be earnings. So I think we came into the year expecting earnings to be really good. We hit Liberation Day, and then everyone cut them, and there was concern with regards to what the tariffs were going to do, and then we raised them again. If you look at historically how performance within the S&P 500 has been, it really is what's driving that earnings growth. Right now, it's been that Mag 7 technology trade. What you're starting to see is the improvement in other areas of the market, and I think you're going to start to see that in 2026. I think one of the issues the Mag 7 is going to run into is kind of the comparisons with regards to these blowout earnings versus kind of the underappreciation within the 493. It gives you a little bit more of an opportunity for outperformance.
And just finally, I do have to ask you about kind of the bifurcation that we've seen with regards to consumer spending, the idea of the K-shaped economy or whatever we're terming it as, but the idea that if you're in the upper income spectrum, you're still spending, you're still doing well, but if you're at the lower end, even the lower middle end, you're not doing a whole lot of spending other than on necessities. Is that a concern at all for markets?
I think that's where fiscal policy, fiscal policy is going to come in. I think the stimulus, as well as some of the tax breaks that are going to be hitting those areas that are harder hit, I think are going to benefit from it. I think the bigger concern that we have is really around housing, and specifically just where rates are. And the fact of the matter is so much of the housing market is sub 3%. And you're in a situation where even if rates have come down, mortgage prices have come down, they're still not as attractive as they once were. And so if you look at the average home buyer, historically it was 39 years old, now it's almost 59 years old. And that's typically the biggest part of an individual's balance sheet. And so not having access to home ownership is still a concern.
All right, Chris, always great to have you. Really smart. Chris Toomey is the founding member of Team Global over at Morgan Stanley Private Wealth Management. A closer look at his outlook for 2026, a closer look at his outlook for the health of the economy and the consumer. And speaking of the consumer, let's talk about one of the hottest consumer brands out there. It has taken over the world, certainly taken over my household. Our next guest, well, he has seen his fried chicken shop from its beginnings at a Louisiana college campus to a multi-billion-dollar business with more than 930 locations in 43 states. The question is, well, what comes next? Well, why don't we ask the founder? Todd Graves joins us here in Studio 2. Great to have you here. Before I ask you the serious questions, I just have to know, my son is obsessed with Raising Cane's, so we spent a lot of time, a lot of money there. But I should point out, I wasn't able to do that a couple years ago because you guys have no presence really here in New York, and now you're everywhere, including like 2 blocks from our house, unfortunately, because for him, we're trying to keep him healthy. Talk about that expansion, because I mean, obviously, if you were down south, I mean, everyone knew Raising Cane's, but if you were up north, it was kind of like, what is this company? Where did they come from? And you guys are huge.
Right. When I started the business 29 years ago in Louisiana, and so we kind of grew out concentrically from there, Louisiana, Mississippi, Texas, and grew out from there. Then we went to up the Midwest, and then we went to the West Coast, and then the East Coast was our latest growth here, and it's been absolutely fantastic. You know, over the years, we're going about 100 restaurants a year now, and that's the amount of restaurants we feel we could operate well, right? And so since restaurants are hard business, you got to make sure you're prepared and you don't overgrow so you don't give that great quality and service.
When you say operate well, so all your stores are owned by the company? Is
Yeah,
that the
they're
idea?
company restaurants, and you know, like franchising works for some concepts, but nobody's going to run your restaurant like a founder wants it to be, right?
Yeah.
Like no one's going to care about it as much as me and my team does. You know, actually, we had some franchisees in the beginning, and I bought them back. We raised sales 35% plus just because I think we operated better.
But how do you do that? I mean, managing, you know, 1 or even 10 locations in the same city or in the same geographic area is pretty easy, I would think, or easier relative to 900 plus, you know, spread out across multiple states.
Yeah, you know, we have almost 1,000 locations and think about across the country, but the main thing is just having great people that literally share your same values and work ethic. And so if you get those people, the restaurant leaders in that restaurant, they're that Todd Graves in that restaurant, taking care of their crew. If you get those types of people, intrinsically motivated, good leaders, then it's not that hard to replicate.
Talk about just sort of how this got into the zeitgeist. I mean, I've been familiar with some of your advertising campaigns, some of the partnerships you've had with celebrities and getting their faces, you know, plastered all across this space. What has been the primary strategy to make people aware of Raising Cane's? Yeah, you know,
it's top of mind, right? And so the traditional marketing for restaurants, you know, it was like fast food was top of mind, billboards, radio, TV. And that's about $0.01 to $0.015 per impression, one person seeing that. When social media came out, right? Now, when I started business, we didn't have cell phones, right?
Yeah.
So I'm like, let me study the social media. I can be at 1/10 of a penny, right? So I can blast out. But what people like is good content. They don't want to see your food every day, and they love celebrities. And celebrities that love my brand, I love to do things with them. So it's like catching the moments, right? So the Eagles win the Super Bowl. Get Saquon 2 days later, I'm with him in the drive-thru working, right? National Chicken Finger Day. My buddy Snoop Dogg comes on. We said it's like Christmas morning to me, but I'm sick, and he had to take over and deliver chicken fingers to all the good boys and girls. And like Cynthia Erivo, like her after, you know, one of the award shows, but immediately after she's at Cane's, right? My buddy Post Malone, and doing great partnerships with them. You know, those things excite people. We tap into their fan base, and then you stay top of mind, and it's actually much cheaper.
So did I hear that you did something related to A Christmas Story here in New York today?
We did. You saw our whole campaign this year. Peter Billings is a friend, you know, original Ralphie from Christmas Story. What
Seen
a great
that about
guy.
100 times.
And we partnered, right? We did a campaign, and what Peter really liked was our charitable components, our bike giveaway. So he's like, can I be at the bike giveaway in Times Square when you do it? I said, absolutely. I said, you be the star of this and come out. Peter actually brought his original Pink Bunny suit. And the cowboy suit and the Red Ryder BB gun. And there was only one of one. They gave it to him after the movie was done. He's kept it in his vault, and he brought it out for everybody to see. We put them in our holiday windows at Raising Cane's. We won Best Windows again, New York, second year in a row.
Yeah.
The costumes really helped. But Peter wanted to be part of that, giving out to the kids. And he and I both were just, you know, had that memory of having a bike on Christmas morning.
Yeah.
And it's just great to give that joy.
Yeah. Well, sorry I missed that. I did a pilgrimage earlier this year to Cleveland, and that was one of the first places I went to go see the house.
Did you really? Oh, my gosh. I can't wait for Peter to meet you. He's going to love to hear that story.
Absolutely. But so talk a little bit about kind of what comes next. I mean, you mentioned 29 years old. I mean, you're a mature company, obviously very successful. You're tracking something like 10 billion a year in sales. How big can this get? I mean, are we talking like McDonald's level, or I mean, what do you want it to be?
Yeah, I want it to grow it as big and as far as I can. I love being part of communities, right, wherever it makes economic sense. You know, we're about 1,000 locations now in the U.S. We could probably do about 3,000 locations here, and we were really well received in the Middle East. We've been there for 10 years. We have 55 restaurants there doing great. We're opening in London.
Was the Middle East your first international outpost?
It really was, and the main thing was my partner there is really, really solid restaurant operator. You couldn't do company restaurants there. The politics and things that go on, better to do a partner. Very good, but they love American concepts, and they don't want you to change anything, no menu changes, things like that. So we've done well there. When that started to do well, then we got these attractions all over the world. I said we could just slow down, really learn this. Our next play internationally is going to be in the UK, starting off in Piccadilly Circus next year, and we're also going to grow into Mexico. We're going to start off in Monterey next year.
So the UK, you're basically chicken fingers and fries, and you're going to be up against fish and chips, which is basically fried fish and fries. So you think you can win over the Brits with our American cuisine?
I think it's just an alternative, right? So like literally, we are chicken and chips, right? It's the boneless chicken on that with the deal. They love that type of concept. We've had our #1 request in all the world comes from the UK, and so we're gonna break out there.
I'm curious about competition. Do you worry at all about I guess, either new upstarts, but even like old ones, like say KFC, maybe they get their mojo back, or Popeyes or something like that?
Yeah, I try not to concentrate what others do.
Yeah.
I say for us, let's just focus on what we do well. We've done the same thing for 29 years. The menu has not changed over all these years. We don't have limited time offerings. All we do is have a exceptional, craveable meal, because I've never cut quality one bit. The cook-to-order process, which goes out, and concentrate on great customer service. That's us taking care of our crew that takes care of the customers. That's the winning combination, that craveable food, but served by friendly people. And the things we do in the community, I think people really resonate with that.
Just real quickly, I only have a few seconds left, but on the customer service angle, and as somebody who's been in your store several times here, I have noticed the way they greet you, the way they give you your food. It's much more personable than a lot of places that shall remain nameless. Is that, I assume that's a training process, right? You just don't just by happenstance find these people.
The main thing is they feel, my crew feels appreciated, right? I appreciate them, and my team appreciates them. And it's a different style, positive motivational management. Typically, I mean, I worked in restaurants in college and in high school, and it was do this, do that. It was negative terms. We're like, hey, please do this. Great job. You tell a 16-year-old kid, that's great toast you're grilling. You think they'd be like, this is easy, but they're like, hey, thanks. And thanks for working that drive-through. You're doing amazing. You're making people's day. If people are appreciated, then they'll pass it on to the customer.
All right, Todd, this is great to have you here.
Great to be with you. I'm so glad. Tell your son I'm going to send him some canes.
I appreciate it. Todd Graves there. If you've seen Raising Canes pop up in your neighborhood, he's the man responsible for it, the owner and founder of Raising Canes. We'll be back in a moment, setting you up for what to watch over the next 24 hours. This is Bloomberg. As we wrap up our coverage here on The Close on this Wednesday afternoon, just a reminder that the biggest gainer in the after-hours trade, that is Salesforce. Some ratification of the AI trade, and we're going to get another read on that tomorrow out of Hewlett-Packard Enterprise, which is scheduled to report earnings. We're also going to get earnings out of companies like Ulta, Dollar General, and Kroger, so a little bit more of a read on the consumer as well. At 7:30 a.m., we are going to get Challenger job cut data. At 8:30 a.m., we're going to get that official jobless claims data out of the government. That's the weekly data here as we try to do a bit of a catch-up after the government shutdown disrupted most of those releases. And then at 12:30 p.m. Eastern Time, I'm told that the Fed's Mickey Bowman is scheduled to speak. Now, keep in mind, the Fed is in a blackout period, so she can't speak specifically about economic conditions and economic policy, or monetary policy, I should say, but she will address some issues with regards to bank supervision and regulation. Full coverage of all of that tomorrow right here on The Close. Please join us then. In the meantime, stick around. Joe Matthew and the team of Balance of Power, they're up next at the top of the hour right here on Bloomberg.